Hey, would you like a piece of over $100 billion that's expected to be paid out over the next 4 quarters by companies that have no competition and are stronger than ever? Then stick around. Hey, what's up? I'm Russ, and this is Dapper Dividends, where we are working to make work optional, and of course we're doing that through stock and crypto passive income. Quick programming note, we're taking a fun family RV trip, which I've never done before, to Mount Rushmore, and I will have something coming out over that next week that we're gone, dividend related, for your viewing pleasure. So the news came out recently that the big banks passed the Federal Reserve's stress test, where they will no longer face the restrictions that were placed on how much they can spend buying back stock and paying dividends. So all that a stress test is a hypothetical scenario that 23 of the largest banks, meaning the banks that had over $250 billion in assets, were put through. Some of these adversities can be found in the Dodd-Frank stress test publications, which I so lovingly went through for you so you don't have to. And these banks faced such adversity as the unemployment rate climbing to 10.75%, stocks falling by 55%, homes declining 23.5%, and commercial real estate falling 40%. So to better understand this, regulators have something in place called the CET1 ratio, or the Common Equity Tier 1 ratio, which measures a bank's core capital, such as common and preferred stock and retained earnings, as a percentage of its risk-weighted assets. In other words, the amount of capital held for unexpected losses and to protect them and us against insolvency. So the regulators require a minimum ratio of 4.5%. If they fall below that, they fail the stress test. All 23 banks just crushed that number with an average of 10.6%, so well over double, and they collectively and hypothetically lost $470 billion. And check it out, in the case of Bank of America, their ratio was 11.8%, meaning they have $35 billion in excess CET1 capital, which means they have $35 billion to buy back shares, to raise the dividends, and to make acquisitions. And from some of these bigger banks, the analysts, as we said in the intro, expect payouts of over $100 billion over the next 4 quarters. The banks have been unleashed. They're ready to open the floodgates of all that capital they've been holding on to. The big banks, as I see it, are the only industry that are insulated and protected from competition, meaning that some of the mid-cap regional banks, there's no way that they're all of a sudden overnight going to grow into mega-cap banks. The way that tech startups do, they can challenge a Facebook or a Twitter, just come out of nowhere. But that's not going to happen with the banks because of the rules and regulations that are in place. Now, DeFi, as I'm a big fan of, that is something to keep aware of and something that definitely could and probably will disrupt the banking industry. But it's going to be interesting to see how long that takes, but DeFi is just in its infancy. It's a little tiny baby DeFi. And I think this is the best sector to invest in on a risk-adjusted basis, meaning that the Federal Reserve or the government, they're the same thing, that they're going to bail the banks out. I remember that JP Morgan, they said, we're too big to fail. Back around 2009, 2010, when they had a market cap of $140 billion. Well, now they're at $464 billion. So if they were too big to fail at $160 billion, aren't they even more too bigger to fail at $464 billion? So in addition to the government bailing them out, they have excess capital at record levels. They're paying their debts on time. They have higher net interest margins. And if the interest rates rise, which is likely to happen, we all know that inflation is coming, and hopefully it's transitory, meaning that it's not going to be here to stay. The banks can increase their interest margin spreads, and they will make more money when the interest rates rise. So all 23 banks passed, but there's 5 in particular that we liked. 4 of them just announced the dividend increase, and 1 of them announced that they're going to be buying back shares.
All right, let's name names and see who they are.
Bank of America announced that they're increasing the dividend by 17% to 21 cents per share beginning third quarter 2021. Citigroup is maintaining its quarterly dividend at 51 cents per share, but they also expect to continue with their share repurchases. Goldman Sachs is increasing their common stock dividend to $2 per share from $1.25. Morgan Stanley announced a 100% increase of their quarterly dividend from 35 cents to 70%, and they're going to repurchase up to $12 billion of common stock over the next 12 months. And JP Morgan Chase, who we just bought some more shares of, will be raising their quarterly dividend to $1 per share, up from 90 cents per share for the third quarter of 2021. So I think every portfolio should have one of these banks in there because of how strong they are and that they are just unleashed now to raise the dividend, buy back shares, make acquisitions. I think they're going to do very well, that they could potentially just outpace the market for the next 3 to 5 years. And again, you don't have to love them. A lot of people don't like the bankers. I know they were responsible for a lot of things, but if you like making money like I do, I invest in Altria, although I don't smoke. And I also invest in some of the banks directly, like JP Morgan. So I put this little spreadsheet together for you really quickly, where the current PE versus the 5-year PE, that's something I like to look at. I like to compare a company's own PE to themselves to see if they're a little bit undervalued in that regard. Then we have the old dividend column, and you can see after the third quarter dividend increases go into effect what that yield would look like if it were in effect today. And the next 4 columns are all Simply Wall Street numbers, which I really enjoy using Simply Wall Street. The payout ratio, that's the amount of their earnings that they're paying out as a dividend. The profit margin, the net profit margin. The Simply Wall Street, how much they're undervalued by, and then the Simply Wall Street fair value price. Against their 5-year PE, Morgan Stanley's about evenly valued. The old dividend, 1.55%, jumps up to 3.11%. Very low payout ratio of 18%. And Simply Wall Street has them about 18% undervalued. Moving along, JP Morgan, just a little bit undervalued based on their 5-year PE. The old dividend, 2.35, just ticks up a little bit to 2.6. Payout ratio, just almost 30%. Profit margin, high profit margin of 32%. And they are about 18% undervalued, according to Simply Wall Street. Citigroup, again, just a shade under their 5-year PE. They are maintaining that dividend, so it will be 2.99%. 23% profit margin. These are all over 20%, about 10% undervalued. Simply Wall Street. Bank of America, current PE 17.1, 5-year is 13.8, so they're a little bit overvalued compared to their own 5-year PE. But again, remember, these are all numbers looking backward, and as investors, we always need to be looking forward, and I think these companies are just primed for sustained tailwind pushing growth. Old dividend for Bank of America is 1.80%. That jumps up north of 2% to 2.09. 31% payout ratio, which these are all just very low and safe. 25% profit margin, only about 7% undervalued from Simply Wall Street. And last, Goldman Sachs has a very low PE of 9.1 with a 5-year average of 13.67. So the past 5 years on average, you're paying $13.67 for every $1 of Goldman's earnings. But currently, you're getting a discount, only paying $9.10 for every $1 of Goldman Sachs earnings. The dividend, very healthy jump from 1.35% to 2.18%. A stupidly low payout ratio of 12%. That is nothing. Profit margin 28%, but they're basically about fair value according to Simply Wall Street at the recording of this video. What's your favorite bank, banking, ETF, anything banking related? Tell us about it. We want to hear from you. Follow me on Twitter at RustyRam78. We can chat there. Drop me a line. I'll get back to you. And check out this video we did on if Walgreens will survive right here. Check it out, and I will talk to you there.